I've been an investor since 2016 in stocks, options, futures, cryptos, and real estate. After years of learnings and making mistakes and losing money, I've consolidated my learnings in this video to explain the fundamental, the principle of investing. If you want to live a financially rewarding life, investing is a must. And to become a good investor, you have to understand these principles. But there's so many things to learn from, especially if you're brand new at investing. And that's why in this video, I'm going to take the 80-20 approach, where we focus on 20% of the things that impacts 80% of the results. After you learn and understand these principles, you'll live a happier life through investing. Now, this video is about investing in general. It's not about stock or option or anything specific in particular. But I will be making those beginner videos in the future, so be sure to subscribe. Concept number 1, compound interest is the most important concept to understand. You probably heard of it from Albert Einstein, who famously said, compound interest is the 8th wonder in the world. He who understands it earns it. He who doesn't pays it. That's why in order for us to become great investors, we have to understand it and know how to apply it. And here's a clip from Futurama that I love so much that explains a lot about compound interest.
Do you still remember your PIN number?
Sure. It's the price of a cheese pizza and a large soda back where I used to work. Panucci's Pizza.
Okay, you had a balance of 93 cents.
All right.
And at an average of 2.25% interest over a period of 1,000 years, that comes to $4.3 billion.
Since no one lives for 1,000 years and no big banks pays you 2.25%, here are two numbers to remember. First is the number 30. That's the number of years we should be using in order to calculate our effective number of years of compound. So this assumes that you start investing at age 25 and you leave it and don't touch it till you're around 55. So that's 30 years on average of the investments that you're making. But you can also use numbers like 10 or 20. That just makes calculation easier. Second number you have to remember is 10%. That's the average annual return from the S&P 500 long term. So if we apply that in real life example, say you invested $10,000 into S&P, that $10,000 would become $174,000. Not bad at all. However, compound interest also applies another way. Instead of thinking of it as an investment, our debt are things that charges us compound interest. So applying the concept of compound interest when we're paying down debt, we want to pay off things that has the highest interest among our debt, because that's what's hurting you the most. And here is this concept number 2. Concept number 2 is opportunity cost. This is what separates an average investor to a good investor. By the way, the next concept, concept number 3, is I think the most important concept in this video. That concept is so important, especially in today's investing climate. Be sure to stay and watch concept number 3. Now back to concept number 2, opportunity cost. Since we're humans and we're not robots, we have finite number of time here on Earth. And at the same time, our resources are also limited. And that's why when we're making investment decisions, we have to understand the trade-off it has. When we're making investment in one vehicle, we're foregoing the opportunity to invest in another investment vehicle. And that's why when we are making decisions, we have to think through the opportunity cost it involves. Here is the example of opportunity cost. Say we invest $10,000 into the SP 500 and we're getting annually 10% return. So that's $10,000 we dedicated to the market fund. However, what if tomorrow there's a new investment came out that gives you a 20% return? Since we already invested our 10% into the S&P 500 and assume we locked in our investments and cannot withdraw, and now we're losing out on extra 10% per year. Because of that, we lost out on the opportunity to invest in that 20% investment. Now that I've explained the concept of opportunity cost and compound interest, here is a real life question that I'm gonna ask you. Let's say you have $10,000 in the bank, but you also have $10,000 of credit card debt. Would it be a better decision to invest that $10,000 into the SP 500 to get 10% per year, or to pay down your credit card debt that's charging you 22% per year? Which one is better? Investing $10,000 or pay down your debt? Let me know in the comments below. Now we're on concept number 3. Congratulations, if you're watching this part, you're one of the few. And this concept is so important. This is what really separates a good investor from a great investor. And this concept is the risk and reward. Every investment, any sort of things that you do, always have a risk and a reward. As a great investor, you will always understand what the risks are for the investment and what are the potential rewards in that investment. Here is a chart called the efficient frontier. This provides a really good visualization on the risk and reward comparison. There are investments that are very risky, but the reward is proportionate to the risk. But there are also other investments that have the same amount of risk but it gives you less in return. When you make that comparison, you will know that the first investment is a better investment because it has the same amount of risk but has a higher return. And here are two things from this concept that you have to remember. There's only one true risk-free investment as of now, and that's the US Treasury bond. That's a guarantee from the most powerful country in the world that they will return your investment with interest. So when people make investment decisions, they always compare to the risk-free rate, the amount of interest the US government is willing to pay on its debt obligations. But in reality, that risk is not really truly risk-free. We'll explain that in a future video. And the second thing you have to remember is that there is no such thing as a free lunch. Always remember this. If you don't remember anything else, always remember this. There's no such thing as free lunch. Take any sort of crypto yield that you see today, any sort of BlockFi promise of giving you 2%, 5% on the coins that you stake. Gemini Earn giving you 4% return on your USDC deposit or Gemini USD deposit. And sometimes back, Coinbase promised to give 4%, 3% return on the USDC that you buy and stake on the platform. Those things all have risk. They're just not properly communicated to the investors. We all know the recent downfall of FTX. And one of the major trigger of that downfall was the collapse of Luna Terra, which is a stablecoin that gave promise of returning 20% yield every single year. In the bull market, everything was working fine. People are making money, everything's going up, so people don't think about and they get blinded by these fundamental principles and they stop thinking about what is the risk involved when you're staking your Terra Luna. When you take your crypto and you put them into things like BlockFi or Voyager Digital, when they promise you a certain percent return every single year, what they're doing on the other end is that they're taking those money and lending them out to hedge funds, lending them out to businesses, and they charge them a higher interest. You're the one giving your deposit to them and they are the one lending them out. A lot of institution investors didn't understand that, or they chose to ignore that. But hopefully after you understand everything from this video, you will have a better understanding of how investing works and you will not make mistakes that will lose you your life savings. As I mentioned before, I'll be making beginner guides on crypto investing, stock investing, all sorts of beginner guides on how to become a better investor in different areas. Be sure to subscribe. Bye.